In this video, traders, we look at the diamond bottom pattern. Stay tuned. Hey guys, warm welcome to you. Alright, so the diamond bottom pattern. No, this is not a new accessory from something out of Housewives of Cheshire or whatever equivalent you guys have got in your country. This is a genuine pattern that is really looking at price action and some kind of reversal. So diamond bottom is this scenario. Let's have a look at what it is, where our entry is, where our exit is, what time frames we could use it on, and whether it's got any value to us as traders depending on what time frame we like to trade. Okay, before I continue guys, if you are a subscriber to the channel, I do appreciate your support. If you make comments on videos, again, appreciate your support. Read the comments, and if you've got questions, you want to add something to the videos, please feel free. Your engagement is appreciated. All right, so diamond bottom, like I say, this is not some kind of bizarre accessory. This is a chart pattern. So we have a drive to the downside, and this is really why it's called diamond bottom, because in theory this is the diamond shape you've got. Right, now I know many of you are going to go, well, what are you talking about? That's just pretty much an inverse head and shoulders, or it's a triple bottom, or whatever. Yeah, okay, this is very specific in strategy and in shape, but they all come from the same thing, guys. And they all come from the fact that supply and demand is shifting, it's shifting again, and we're getting insights into where the price could go. So let's talk about this. The theory of this is we've driven down, we've pulled back, we've driven to lows, pretty textbook trend stuff at the moment. Now we've undone that and we've gone long. Well, actually, we quite often would go long here, and you get caught out on these kind of things. But it's quite interesting that you can perhaps add this as a kind of recovery trade if you like. But forget about that for now. We push down, push to new lows. We don't push any further than that. We go back up, we cross above the high. We push up, we fail, we come back, we retest into that chunk, but we don't go to new lows. Okay, this is a coincidence that's kind of just below that. It's anywhere low, but not to a new low. We then push up again, we don't push the highs, we come down, and then finally we push up. Now, this is a little bit grubby, isn't it? Because if we look at this from this perspective, we've gone to a new low, we've gone to a new high, we've come down again, we've gone up again, we've done this, we've done that. It looks a little bit scruffy on that perspective, and that's probably a little bit high, but you get the point. But if we look at it from supply demand and exactly what's happening, drive lower, pull back, standardized stuff, new lows, standardized trend stuff, rejecting the lows, pushing back, standard stuff. Now, we get interesting for me at this point. We've broken above the high. A lot of people might go long here. I might be one of them depending on what the situation is. We push up, we fail, we reject, we come back. People like me who have gone long in here probably pinging off stops into this low. It's not enough to send us to new lows here. That's the key that everyone's watching, right? The buyers have stepped in a little bit early. Perhaps people who are a bit keen have maybe got caught out on that. It's now pushing back up. Still not there, and then it finally starts to go. Now, a lot of people would probably buy on this here, which is why this kind of works quite nicely, because the actual buy point for the diamond bottom is here. So you're buying as it breaks out of this diamond shape, and the assumption on the hope is that, we shouldn't hope, but you get the point, is that as it starts to break through this high, that's going to add some more fuel to the fire, which if you're a short-term aggressive trader, you'll be able to scale into there. Now, this works well. I think you'll have, or should I say, it will be effective on multiple different time frames. So your day trades, your daily charts, I think it will work very nicely. Your intraday trades, you probably find you've traded something like this already without realizing that that's perhaps the entry there, and getting in a little bit early on the earlier side as it kind of comes through that diamond as opposed to that high. But intraday reversals, you can see quite nicely how it work. This could be a 1 minute chart, could be a 5 minute chart, and it makes sense. If this is an area of interest that you want to do business in anyway, like the whole price action ethos is that, guys, it's got to be something of interest to you in the first place. Prices come down, you're in an area of interest, you start to get this little pattern, then maybe throwing in a buy on that diamond break as opposed to some other places might add a little bit of extra edge to the trade. And you can see it's kind of a reversal pattern that's a bit grubby that catches a few people out. Now your stop on this is probably going to be under this swing here, or you could go under this swing here. I wouldn't put it right the way under there. I feel that's quite broad, and this has still got a good chance of testing and doing some kind of business down here. But it's worth a crack if you can have the stop nice and tight as you can if you've got it under that subsequent low there and that little area there. So it keeps the risk reward decent, because actually, just finally guys, you can see, that risk reward extrapolates extrapolated, it's 1-to-1 just for that high. If we do break that high, you're on 2-to-1, 3-to-1 in this example. I know it's rough, but you get the idea. So for a risk-reward ratio, it's kind of worth taking, especially if this is an area of interest anyway, a broader, longer term support on a higher time frame, it might fit in quite nicely. Anyway guys, that's the diamond bottom pattern. Take care, see you next one, bye bye.